stock market morning prep video for Tuesday, August 26th. Green across the board again. The pre-market strength actually followed through, and we did gap up on pretty much all of the five indices that we follow. But again, don't let it surprise you. We did have a gap up, and we ran a little bit, and then we kind of sold off midday, and then kind of chopped around pretty much most days. So very subdued trading. If you weren't in front of your screens trading, you would think the markets actually had a very good day. But other than the gap up and a little bit of a push higher, we really didn't do too much. Stocks really didn't do much at all. To be expected. The last week of August, everybody is gone. It is so quiet out there at the moment. But rest assured, everybody's coming back next week, and I'm looking for some good volatility coming into September, that's for sure. Summer is going to be behind us, and we should be picking up on a lot of trading, a lot of volatility, and, of course, increase in volume. So we have green across the board, but as you can see in front of you, the SPX cash tagged to 2000, actually went to 2195. Now, the analysis that we had with the inverted head and shoulders was off the ES, so it kind of tracks behind the cash about 3 points, 3 or 4 points. So it went as high as 1999.75. So that's pretty close for government work, that's for sure. So we're a quarter shy. I still think it will tag it and go to that extension. So not bad, but you can see here right up the bat, 930. We ran up just a little bit going into around 11 o'clock and sold off and then bounced, and pretty much were flatline most of the day. So very, very quiet, but again, to be expected. So we didn't quite get that big push up, so I'm still looking for that one more capitulatory push higher where we can get outside these Bollinger Bands and the McClellan Oscillator and then start possibly fading the move. Now remember, if this is counter trend, so if you are new, I would not recommend it. But if you are a little bit aggressive, you can trade this counter trend. And the only reason why I say this is that the markets are up probably now 11 out of 13 days, straight up vertical in a line with no volume. Once I think the market participants come back next week, I think partly they're going to take some profits. And again, even if they did take some profits and you faded it and you made a little bit of money, that's something. But I do think that they were looking for a decent move to the downside, and I thought we were going to get some follow through at least from that move a few weeks back. But obviously, markets bounced and buyers and dips came in. So the repetitive pattern continues of buyers and dips. Now, the only reason where that goes away is when they start getting burnt, and it's hard to make money that way. And that's not happened. It hasn't happened. And I'm sure the Federal Reserve is going to keep it that way. But eventually, you can't go without a 10% correction, 8% correction. It's been over 3 years, probably going on 4 now. And that's not healthy for the markets. It's just not healthy. I could care less if I was a buyer or a seller. I just trade what I see. But it's easier when markets are pulling back, digesting a move, where you can actually buy that dip normally, not just buy the dip because you know that the market's going to go higher. At one point, it's going to change. So just, it's a word of caution. We have market divergence. IWM is actually still diverging from the other indices. It is one of our leaders. We have indicators breaking down, showing us that we're either elevated or not supporting the move higher. So a lot of red flags. We've had that all throughout the year. So until it changes, you got to have a word of caution, and that's pretty much use caution in your trading. Anyway, so we want to get this spike back up here a little higher, and then look to probably fade that move. Now, usually when you get that milestone 2000 or any round lot number, we usually get a pullback or a pause. So let's just keep an eye on that for the coming sessions. Now, here's the ES, as you can see, 1999.75, and this is off of our head and shoulders, inverted head and shoulders that we identified several weeks ago. And I also got a couple of emails that they've actually made some good money doing so, and that's great. What I'm looking for now is I'd like to still see a push higher, break above 2000, and the buy stops on the short start to trigger, and then we push back above the 206. Once we do that, and I think we make new highs, I think they actually start to sell off again. Now, do we sell off all the way to the lows? I have no idea, but we will monitor when it does happen. I wouldn't sell into this as long as we get a trigger. Then I would start selling. But before that, just because prices at these areas, I wouldn't just look to short the market. Okay. Remember, the markets can continue to grind higher, so you want to have a perfect trading plan based on your account size and, of course, um, uh, your mindset as far as where you want to go with your trading. You also need to understand your risk tolerance, and if you're good with the tolerance and you're okay with taking a little bit more risk, that's fine. But you still want to follow a plan. Very, very important. Okay, so let's go take a look at the other indices. Diamonds here, it's starting to challenge the highs here. As you can see, we did put in a doji. And, you know, when you're up this far and this fast, it needs a breather. And now you have the highs along with this downtrend, this uptrend channel, the lower trend line, obviously, now acting as resistance with low volume. So let's see if we can get a little quick pop and then fail. I have targets from the upside. I have targets to the downside. So let's just see what happens here in the next coming days. Now here is really, the canary in the coal mine. We have the IWM really not following suit. We have a lot of the indices challenging highs or making new highs, and the IWM has not done so. So to me, I still think that either this has to play catch up in a big way, or it starts to break down. And when the IWM start to break down, I think you're going to have, and I think this time, like you said, when we had this breakdown, I think this is partly why the market sold off. We did get a small recovery, but not as great as I'd like to see in the IWMs, as you can see here. So it is lagging. So that's definitely defined market divergence. So let's see if we get this roll over and start to roll back down again. If that happens, then I think that you would see some of the other leaders start to follow suit. Now the transports are interesting. We did say we're looking for this pivotal low here for a test. We did get it. And again, we've rallied all the way back up, and now we're just pausing here. You can see here. So actually, the pause is still bullish underneath the highs. So my guess is that I think we get one more pop, and then push into these extensions. The 1272 extensions actually lines up perfectly with the upper channel resistance. So this is going to be a confluence area of resistance. 155 also is a round lot number. So let's see if it gets up there, and if it does, I would be inclined to look to fade that move as well. Remember, every time it hits a high, remember the repetitive pattern, we sell off. We hit high, we sell off, and if you go back, you'll see all the time, every time it hit that channel, it sold off. So that's what I'm looking for the next fade in this IYT, and eventually, I think that the transports start to roll over, and I do think that it breaks these lows, and eventually, at one point, challenges the 200-day moving average here. Okay, and lastly is the Qs. Now the Qs are doing great. The Qs have done spectacular during the sell-off. Hasn't gone really anywhere. So this has relative strength to the rest of the indices that we follow. So it's looking at the 1618. I believe that it'll get to the 1618 and hit that round lot 100. Make another all-time high yesterday, and let's see if we do get a little bit of a rollover here. The earnings season has not been great, and I do think that some of these numbers, economic numbers, hasn't been so great as well. But you do have this euphoria of the Federal Reserve continually supporting the market, and that's the only reason why this market is at these levels, is because the Federal Reserve is supporting the market and continues to put liquidity into the market, so you can put liquidity into the market as well. And create that wealth effect. Okay, so everybody feels all great and dandy. Now that's all well and good, but at one point in time, it's going to end. So we need to really be aware of that. Now, when does it end? Who knows? But as traders, we just trade what we see for now. And again, I would love to see a little bit of a pullback. I'd love to see, a 6, 8, even 10% correction to actually start accumulating some stocks to the long side going into the holiday season, and that would definitely support a real good Santa Claus rally. Okay, just a little quick analysis further out. All right, guys, have a great day. It is getting slow, so don't push it. As the day goes on and we're going into the Labor Day weekend, it's going to get worse and worse. So remember, a couple of trades, put in the bank, and go out there and play golf or fishing, whatever you like. Have a great day, everybody. We'll speak to you tomorrow. Take care.